How's it guys? Welcome back to FX Rhapsody. Today I just want to show you how you can do entries on multiple time frames. Before we hit the charts, just go visit my website. It's on the bottom left corner here where you can find some previous analysis, previous strategies, you name it, anything you can think of about trading. And there's also my preferred brokers. Just go check them out. These guys are really brilliant. One of the top brokers around. So guys, let's hit the charts. So a lot of traders focus only on one time frame, especially when it comes to entries. And they will do their analysis on higher time frames from your daily down to your hourly or whatever the situation. But then they get stuck on a time frame that they take their trades, be it the 1 hour, be it the 15 minutes or whatever time frame. They do not jump from one to the other just to see what's happening and where they can find more entries. So let us just look at this, in between these two lines. This was this is GBPJPY, British Pound Japanese Yen. This was basically the beginning of the week, and I just want to show you what happened. So basically, price went from the high to this low, and then made a nice retracement. So for those of you that's been watching my videos, all you do is you take your Fibonacci from that high, that swing high, to that swing low. Okay, that's relatively easy. Okay. From the top of the week to the bottom of the week, and then you get a retracement, and as we can see, there was a nice retracement all the way to this 62% to 79% area. So I'm just going to extend this. Okay, so that's obviously a nice entry for a sell. Now a lot of traders, what they do is they wait for this the price to come up to this entry, because now they see the swing high, they see the swing low, and now they sit and wait and wait and wait until price gets there. But you don't always have to wait. Okay, you can drill down to your lower time frames, because there's always entries that's going to happen. So let's just take out this Fibonacci, and I'm going to leave that zone in that we just drew in. This is the, like we said, between the 62 and the 79%. So let's just go down to the 5 minutes and I'll show you something. Okay guys, so this is the 5 minute time frame. I'm just, it zoomed out a little bit, so I can just show you. This is basically, that was the swing high that we were talking about. Okay, and then obviously this is the swing low at the bottom. So I'm just going to do it there. That was the top of this. So I'm zooming this in a bit. Okay, so now as we see price going down, okay, we see price moving down. So price hitting that bottom, and this is the time that you sit on the hourly and you say, okay, I want to wait until price reaches this area, and then I want to sell down. But why don't you just buy up as well? Because you can see price bouncing up in the bottom here. It is basically doing a nice consolidation. It forms nice structure, and then there's a nice area over here. Look here, that right there. There's nothing special about it. So, or a different type of trading. So you have a structure that gets broken, and then what happens is there's a fair value gap that gets formed. Okay, so that's the area between those two candles, as you can see right there. And then once price comes into this area, and as you can see price hovering in this area, then this is an opportunity to sell. Okay, because what you do is you place your sell right about there, and you have your stop loss just below that area. So now it's a risk that you have in place. So if price continues downwards, it will tap your risk. But I mean, this is on a 5 minutes, so you're looking at about an 8 pip risk. And then you trade the trade up. Okay, you trade it up. And then where do you trade it up to, and where does price go to? Remember I showed you that this is the retracement to the 62%. Now if you go to this side, if you look left a little bit, you can see that price came up, and then it made a turn of a swing high, and then it went down. Now with this movement upwards, it created a single bearish candle in between the two bulls. I'm just zooming in to show you. Okay, so that is structure. That is a support in the market. So I'm just drawing a line right there, as you can see. So that acted as a support, and then price bounced up, and now price came down. It broke that structure. And what happened when it broke that structure? It created a fair value gap. So now I can just do that, and then that area gets smaller. So what does price do? Price goes and gets drawn to that liquidity area. So moving a bit sideways, my take profit will be there. Okay, that's going to be my take profit area. Okay, so I'm taking that out. So now what I'm doing is I'm just leaving this. So this is now the 5 minutes. While a lot of guys have been waiting for price to retrace back to that area, I'm buying up. Okay, and if you bought up, you would have had at least a 60 pip reward already. So you would have been sitting with 60 pips in the bank when other guys are waiting for this trade to retrace up. Okay, it's as easy as that, guys. So when we go to the hour back to the hour time frame, okay, now with the hour time frame, you can see now this area gets smaller. We pull in the Fibonacci again, because I'm just taking, you can leave the Fibonacci in there, but I'm just taking it out just to show you guys, just, you know, so that it doesn't confuse you guys more. Now you have a nice entry point for a sell because it's retracing back to that area. Okay, so now what you do is you place your sell, because that's the area that you've been waiting for in any case. So what you do is you place your sell right around there. That's your fair value gap that's formed here. Price gets drawn because there was a fair value gap that formed on the 5 minutes. So you place your sell right there. Now your reward or your risk is smaller again, because if you place it on the 5 minutes and you go according to that fair value gap that was formed, that imbalance, you put your risk just above it. So now you have a smaller risk instead of this high or bigger risk. It depends on where you wanted to take it or put it. But you do have two confirmations. You have your Fibonacci retracement, which is to the 62%. So you're obviously waiting for that area. Okay. For those of you that's only trading Fibonacci, you would have had your trade placed there, because like I said, you know, you place your trade when it hits at 62%. And then you have a bigger risk, as you can see there. A lot of guys will put their risk up here, depending. Okay, so that's huge. But now, because you have a retracement of a Fibonacci, that's one confirmation. Second confirmation will be on the 5 minutes. It's created that imbalance, that fair value gap in the market. So that's your second confirmation. And that is when you place your entry, when it gets round about there. You place your risk a lot smaller, and now you can trade it down again. Okay, now price moves down. So now the question is, where does price go to? Okay, what is your take profit or your target for the bottom? Now you scroll out again. Okay, now let's scroll down, or let's zoom out, and lo and behold, when price started moving up, it broke a structure right around there, similar to what happened in the 5 minutes. Remember, structure, price going up. What does it do? Creates a fair value gap right there. Okay, you can see that it's in between those two candles. It's very simple, guys. Now you just draw it out to the side, and bam, look at that. So all you do is you place your trade, and your reward will be this area over here, because price gets drawn to that fair value gap. I'm not taking examples out of certain situations. This happened this week. Okay, I was talking about analysis, and I drew these two lines, right? For those of you that didn't watch the analysis, go watch it. It's the British pound Japanese yen analysis I made, and I still said I'm waiting for price to react to these two lines and see what's happening. So this is the reaction. So now you're already sitting with a 60 pip buy that you bought up to this retracement on the 5 minutes, and now you sell it down. Okay, so you sell from here all the way down to this area, which is another 150 pips. So you're sitting with 210 pips in, what's it, 2 days on one currency pair. And this is your risk. I just showed you how you place your risk. I showed you where you take your reward. Okay, it is very, very simple and easy. So let's say you missed this entry. Okay, so let's take out this Fibonacci and this area. So let's say you missed that entry. Was there a second entry that happened? Yes, there was. So when price went up here, it did consolidate a little bit. Then it had another break of structure. Okay, you can see that on the lower time frames as well. You can zoom in. I'm not going to zoom in again, but you'll get what I'm saying. So that was the break. So let's make it there. That was the break. It created a fair value gap in the market. And another rule that I sometimes use, or most of the time, is when, especially if the fair value gap is so big, and people will ask me, where do you enter and how do you place your risk? Because for instance, let's say that this is the imbalance or the fair value gap. A lot of guys will just, where in this area will you enter? Will you enter at the bottom and have your risk that big? Or will you enter, closer up and this and that? What I do is I take my Fibonacci from the top to the bottom of that gap that I've highlighted. I mark out the 50% area. So that is halfway of that imbalance. Okay, that's the halfway mark of the imbalance. And that is where I target my entries. So when price gets halfway to it, so that is going to be that area, I take my trade, and then you can see the risk is a lot smaller just above that fair value, or just above there. Okay, so that is a bigger risk that you could have taken, but that's a second opportunity. Okay, second opportunity for price, breaking structure, creating fair value gap, pushing up again, and then you slam another trade down, or you slam the first trade out. For those of you that was in the first trade, you could have you could have seen this happening, price coming up, your trades is still open, and when you see this created and movement down, you enter more trades. For those of you that wants to be a little bit more risky in your trades, so you would have had 2 entries or 3 entries depending on how your style of trading. Again, price just moving down to that gap that it formed. So guys, it's pretty simple. Like I said, I'm trying to show you guys how to just simplify your trading. And like I said, that was one currency pair, 200 pips at least. What you do is go to your currency pair that you're trading, or whatever you are trading, go back on your charts, map out. A lot of guys, watching these videos have got the different time frames of trading during the day. It's not necessarily that, my day will look exactly like yours time-wise. So what you do is draw out a little section in the market. Okay, let's do a vertical lines. Let's say that's your day. Okay, let's say that's your trading day right there. That's the area that you trade during the day. That's your time that you have. Go back on the chart. Go back. Map out the same times every single time. Do it for a couple of days back. They call it back testing for those of you that's not familiar with it. So what you do is you map out that area in the charts, go back on the charts, and then go see if something similar like this happened. Not exactly, obviously, but fair value gaps get created. Retracement of the Fibonacci. And the more you look at that, the more you see it happening in the market. When you go back, you say, okay, cool, I see that's a fair value gap formed. Oh, I see the retracement happening. Oh, yes, that's a retracement on the Fibonacci. The more you see it, the more your mind will train to see it. And then as soon as it happens, guys, you will go, oh, yeah, it's happening. And you will think to yourself, how do I know that? It's because you've seen it so many times. Your brain gets trained to do that, okay? So that's all it is. A lot of guys don't like backtesting, but that is a necessity when it comes to trading. And if you wanna be successful in your trading, the more you see a thing, the more you do things, the more you do a certain thing or certain, doesn't matter what you do, the more hours you put into it, the better you will get. Okay. So guys, that's all from my side. I hope you enjoyed this little, I wouldn't say analysis, but a little section of trading. And yeah, I hope you caught some pips using this method this week. So guys, that's all from my side. I hope you enjoy your day, and I hope you've been having a fabulous week. Stay safe and happy trading, guys.